Hi, everybody. Jeff Rivett here, Portfolio Manager with Cree Capital Management Group at National Bank Financial. Hope everyone's having an awesome summer. Here with my August market update, and it's been a bit exciting in the market the last few weeks. So hopefully some more of you will watch this than usually would for a summer market update. Also, I point out that we did do our quarterly webinar last month in July, which was a full update on the portfolio, all the positions, how we're performing versus the different benchmarks, and how we're performing in different areas. So if you'd like more information, certainly on your portfolio, I would highly suggest watching that video. It's a bit long, but there's bits and pieces there that you can sort of sort through. And hopefully our next quarterly update, which will be in, I guess, October, we'll see a few more people out than we saw in the summer, because I think a quarterly update in July is not the most popular thing to do on a sunny day. So anyway, the markets have been pretty exciting here the last few weeks, and I think a lot of people are wondering sort of either how they're doing or are just closing their eyes, not wanting to look how things are going. So I will tell you, things are going very, very well for our portfolios. I was looking at the numbers this morning. Our balanced, as of the end of July, so about a week ago, our balanced portfolio was up about 11.5% on average year to date. And we do have some clients that have, most of our clients are balanced. We have some clients that are more conservative, and so more of a bond mix. And then we have more clients that are a bit more aggressive. But majority of our clients are in that balanced model. So as the end of July, things were very good. Like I said, about 11.5%. And comparing that to sort of the average balance fund in Canada, end of July was about 9.5%. So, pretty good, holding up about 2% above 2% above the average in Canada for our group, which is phenomenal. The last week has seen a drastic turn in that for the market. So in our portfolio, we've gone from about 11.5 down to about 8.6 as of yesterday, year-to-date performance. So we're up about 8.6% still in the year. So a loss of a little bit less than 3%. The average fund in Canada has gone from 9.8 down to 4.6. So a massive change there. So again, we've fallen shy of 3%, and the average fund in Canada has fallen more than 5%. So we're holding in really well. And that's kind of what we do. I tell people that when markets are going up, we want to be there. We want to participate. We want you to be able to talk to your friends at cocktail parties and be happy about where you are compared to everybody else. But really the time you get to brag is when things are going badly, when no one wants to talk about their investments, because you can sort of sit there and be like, you know what, I'm still doing just fine. Thank you very much. We've been lucky, and I guess have made some good calls. We're about 59% in equity in our balance model. So that's a bit less than the average fund would have. So a little bit less exposure. We've had less exposure to sort of the big tech names, which have been the ones that have really been hit the last week and a bit here, which has been great. We still have a massive cash and short-term bond position. So we're sitting at about 12% in sort of short-term bonds and cash. And I've said before, I think it just makes sense to be there, because we're getting paid sort of 4 to 5% right now to sit and hold those kinds of investments. They're safe, and it still gives us the opportunity, if we need to obviously reallocate that cash if and when we do have market corrections that come along, and we see that the timing is right to do that. So I'll talk sort of briefly about just the general what's happening and the general psychology, I think, of what's going on right now. I mean, you can look up, why is the market falling right now, and there's recession concerns, there's unemployment concerns, there's rate concerns, there's election concerns. There's plenty of different things that people will point to, but I in my experience and the way that though I see it, it's more just a market that kind of got away from itself. And I've been saying that for a few months now in my updates that, number one, the market was largely, the performance of the market has largely been concentrated in those large tech companies. Um, and those companies have become almost like a can't lose bet. Companies like NVIDIA, I mean, I was walking along the seawall a few weeks ago and there was a guy with an NVIDIA t-shirt with a green arrow pointing up on it. Um, so, when you see investments that start to become almost like that you can't lose type mentality, and they just keep going up and up and up and up and up, that is generally a warning sign that that's going to be mean reverting and change. Um, and so, I think that the market was sort of ripe for instability and ripe um, for a shift. I don't think it's anything to be super worried about. I do think it is an opportunity, but I think that people that are jumping in right now might be a bit early. Um, I think that we have had a really good run, um, and the general feeling I get from the psychology of the market is, this really is the buying opportunity. We need to get in. Here we go. Like, prices have pulled back. Let's get in. Let's get in. Um, I think that we probably have a week or two more of sort of this instability. And I'm recording this on August 7th on Wednesday. We had a bit of a rally yesterday coming out of the long weekend. Obviously Monday was a really bad day in the U.S. There was massive headlines everywhere about that. So, a bit of a rally yesterday, but not a great rally back. And then today the market started off positive and kind of slowly faded negative. So I do think that portfolio managers are starting to shift into being more risk off, to being more cautious. And also it's kind of a weird time right now in the summer where people are on holidays and there's less activity in the market. So it is a bit more sensitive to both negativity and positivity. And because the sentiment is a bit negative right now, I do think that we could see a further decline in equity prices. Right now, the S&P 500 in the U.S. is only off about 10%. So not a major on the continuum of the markets. It's not really a big correction, but it is something, and I could see it maybe coming down another 5 or 6% or so, and then of course, as mentioned, we obviously have cash positions that we would shift to take advantage of that. Right now, we're looking at moving some of that cash into either the S&P 500 directly, just into buying the S&P 500 as a market, the TSX in Canada, which has sort of had similar performance trajectory. That's another area we look at, and I think the other area to sort of offset that is long bonds, long-term bonds. We do long-term bonds. We already own a chunk of those in the portfolio. They pay well. You're talking about government U.S. government bonds primarily, that are paying close to 5% for us to hold them. So certainly getting paid a good income. And these bonds, that we purchased, they are 45% cheaper than they were a few years ago. So they're at a big discount. The reason that they're down so much is because interest rates went up. And if we do have sort of a sustained recession, or we do have some market instability, I do think that we'll start to get rate cuts maybe a bit faster than had previously been expected. And if rates go down, then bonds will go up. So I think there's some upside there to be had in the bond market if things do continue to get weaker. So we'll be looking to add to those long-term bonds. We'll be looking to add to equity when the time is right. And other than that, we're just going to sit and watch and be happy about how well the portfolio is holding up in this period of time. Like I said, if you have any questions, certainly do check out the quarterly webinar video from last month. That may answer some of them, and I think there was some great questions in that video at the end. And as always, feel free to reach out to myself or any of their team members. We're happy to talk to you about your individual portfolio and go from there. So I'll leave it there, and I will talk to you all in September. Thanks. Bye-bye.